Imagine a company, let's just call it Apex Innovations for a second.
Okay, I like it.
So by every traditional metric, Apex is basically the darling of the business world. Like their order books are overflowing, their profit margins are widening,
Right.
their EBITDA, earnings before interest, taxes, depreciation, and amortization is just skyrocketing. Wall Street analysts are doing backflips over their quarterly projections.
Naturally.
Yeah, and the CEO is currently on the cover of like every major business magazine, but then Thursday morning rolls around.
Uh-oh.
Exactly. The gates to the manufacturing plant are padlocked. The suppliers have completely halted shipments. The employees are walking out.
Wow.
And by Friday afternoon, this highly profitable, industry-dominating titan is sitting in bankruptcy court.
It happens so much more often than people think.
It does. And the question is, how does a company making millions in profit suddenly just go belly up?
Because you cannot pay your employees with EBITDA.
Exactly. You can't pay your suppliers or your taxes with projected revenues. And you certainly cannot pay them with profit margin.
No, you pay them with cash.
Right. You pay them with cash. And if that cash is trapped in a warehouse full of, I don't know, unsold inventory or sitting on an unpaid invoice with a 120-day net term,
your company is dead in the water.
Dead in the water.
And that is the ultimate terrifying paradox of corporate finance. It's actually the absolute perfect place to begin our discussion today.
I agree. So welcome, everyone.
Yes, welcome. And for those of you listening, you, the ambitious MBA student who's currently staring down complex financial frameworks, this is the reality you are stepping into.
Today, we are doing a deep dive into the architecture of cash management, specifically looking at a comprehensive text on Corporate Finance Unit 16, focusing entirely on cash management.
Because, while topics like hostile takeovers or leverage buyouts or, complex derivative trading often steal the spotlight in your finance seminars.
The flashy stuff.
They are. But absolutely none of those mechanisms matter if a firm runs out of its lifeblood, cash. It provides one ultimate non-negotiable superpower to a corporation, which is liquidity.
Right.
It's the ready currency to which all other assets must eventually be reduced just to sustain operations.
But as a future corporate leader, managing that cash is, well, it's a massive high-stakes tightrope walk.
It really is.
So our mission today is to completely decode this. We are going to unpack the strategies, the mathematical models, and the deeply complex real-world friction that CFOs navigate every single day.
Because we want you to not just memorize these terms for your exams, but to intuitively understand them. We want you to be able to apply this when you're the one in the boardroom.
Okay, let's unpack this, because the foundational premise of cash management is built on a massive contradiction.
It is.
Cash is the most vital asset for the survival of the enterprise, right? But when it just sits there, idle in a corporate account, it is actively destroying value.
Exactly. It earns zero return.
Yeah, it acts as a massive drag on a company's return on equity, and it steadily loses purchasing power to inflation.
So it's punishing to hold.
Right. If holding cash is so economically punishing, we need to understand exactly why a multi-million or multi-billion-dollar enterprise deliberately chooses to hold a massive chunk of its capital in a zero-yield state.
Well, the rationale really comes down to four fundamental pillars, or motives, that drive corporate cash reserves.
Okay, let's go through them.
The first, and definitely the most foundational, is the transaction motive. I mean, a business is an incredibly dynamic, living organism.
It's not static.
Exactly. It doesn't exist in a static state.
Yeah.
Every single day, capital is bleeding out of the firm to cover ordinary course of business activities.
Like purchasing raw materials, covering massive payrolls,
paying utility bills, leasing equipment, distributing dividends to shareholders, and simultaneously, cash is flowing into the firm from sales revenue or asset liquidations.
Right, and in a perfect theoretical vacuum, maybe the kind you see in like an introductory economics class, the money coming in perfectly matches the money going out down to the second.
Oh, wouldn't that be nice? But the real world operates on friction, not perfection.
Right.
If a customer paid their $1 million invoice at the exact millisecond your $1 million payroll was due, you wouldn't need a transaction balance at all.
You can just route it straight through.
But inflows and outflows are almost never perfectly synchronized. The client demands 90-day payment terms, but your workers demand a paycheck every 2 weeks.
They aren't going to wait 90 days.
No, they are not. So the transaction motive is the cash required to bridge that inevitable structural gap between money arriving and money leaving.
It's the buffer.
Yes, the buffer that absorbs the daily friction of commerce.
Which makes total sense. I like to compare this to personal finance just to make it stick for the exams.
Oh, that's a great way to think about it.
Yeah, so the transaction motive is basically your personal checking account. You have to keep the lights on and the assembly line moving. But then we introduce the second pillar, which is the precautionary motive.
Yeah.
If the transaction motive is about predictable friction, the precautionary motive is about surviving chaos. It's your rainy day fund.
Precisely. The precautionary motive is the massive capital buffer a firm maintains for entirely unpredicted, unanticipated systemic shocks.
Like emergencies.
Exactly. The modern business environment is inherently volatile. You're talking about black swan events or sudden operational disasters.
A catastrophic flood shuts down your primary distribution center.
Or a key supplier suddenly goes bankrupt, forcing you to source materials from a premium vendor at, like, triple the cost.
Or a sudden labor strike halts production.
Or a global pandemic freezes international shipping routes.
Right.
When these shocks hit, your revenue plummets instantly. But your fixed costs, your debt obligations, your leases...
Well, they don't stop.
They absolutely do not stop. So the precautionary balance is the financial armor that keeps the firm alive when the environment turns hostile.
I imagine the size of that armor varies wildly, depending on the industry, though.
Oh, significantly.
Like a software as a service company with highly predictable recurring revenue probably needs a much smaller precautionary buffer than, say, a global airline.
Absolutely. An airline could be grounded by a volcanic eruption or a sudden spike in jet fuel prices overnight.
Right.
So that's a crucial distinction for students to remember. The magnitude of the precautionary balance is directly correlated with the historical volatility of the firm's specific cash flows.
High-variance industries require massive precautionary reserves.
Exactly.
Which brings us to the third motive, and this is where things get kind of aggressive. The speculative motive.
My personal favorite.
Because this isn't about hiding from disaster, right? This is about maintaining the firepower to hunt.
Yes, having dry powder.
It's having that cash specifically to capitalize on unexpected, deeply asymmetric opportunities that pop up completely outside the regular course of operations. Right. Like having cash ready for a stock market dip in your personal portfolio.
What's fascinating here is that cash, in this context, is an offensive weapon.
Right.
Let's say you are a major consumer electronics manufacturer. Out of nowhere, the price of a critical rare earth metal plummets due to some geopolitical shift.
Okay.
But the window to buy at that price will only stay open for 48 hours.
If all your capital is tied up in illiquid assets or long-term bonds,
you miss the opportunity entirely. Yeah. But if you have the speculative cash ready, you can buy up a 2-year supply at rock-bottom prices,
securing a massive competitive advantage
and locking in extraordinary profit margins. Or perhaps a struggling competitor suddenly puts a vital patent portfolio up for sale, but they demand an immediate cash transaction.
You have to have the cash on hand to strike while the iron is hot.
Exactly. And we have the fourth pillar, the compensating motive, which feels very different from the other three.
Yeah, because this one is entirely dictated by the firm's relationship with its commercial banks. To use the personal finance analogy again, this is like the minimum balance your bank requires you to keep so they don't hit you with maintenance fees.
That is a perfect analogy. The compensating balance is a uniquely structural requirement of corporate finance.
Right.
Massive commercial banks provide an incredible infrastructure for corporations. They process thousands of daily transactions, manage complex payroll disbursements, extend massive lines of credit.
Buy foreign exchange services.
Right. Now, they charge direct fees for these services, of course, but they also demand indirect compensation.
Which is the catch.
Yes. They stipulate in their lending covenants that the corporate client must maintain a hard minimum cash balance in their commercial accounts at all times.
And this is capital the corporation literally cannot touch.
No, it is legally sequestered.
The bank essentially uses that massive corporate deposit to lend out to other clients and earn interest while the corporation is forced to leave it dormant.
Exactly. And for a multinational conglomerate, a compensating balance isn't just a few $1,000s.
Right. It can be tens or hundreds of millions of dollars of completely immobilized capital.
It is the invisible cost of the banking relationship. So, when an MBA student or a future CFO looks at a balance sheet and sees a massive cash pile, they really need to realize it isn't just one monolithic block.
It's segmented.
Yes, highly segmented. It's a pool of capital serving these 4 distinct masters: facilitating transactions, guarding against disaster, hunting for opportunity, and compensating the banking syndicate.
And understanding those motives leads us directly into the ultimate strategic dilemma of the CFO.
Yes, the balancing act.
Because we know why we hold the cash. But what is the actual goal? The foundational frameworks of corporate finance outline two core objectives of cash management.
And they are in direct, hostile contradiction with one another.
Totally. It is a constant, incredibly delicate balancing act. Let's break down the first objective.
The first objective is the most obvious, meeting the payment schedule. A firm absolutely must maintain enough immediate liquidity to satisfy its obligations to suppliers, employees, creditors, and the government exactly when those obligations come due.
Because failure to do so triggers a catastrophic cascade.
It does. First, you lose access to lucrative early payment cash discounts.
Then your credit rating is downgraded, which instantly makes all future borrowing vastly more expensive.
Next, your suppliers lose confidence and demand cash on delivery.
Which just suffocates your supply chain entirely.
And ultimately, it leads to technical insolvency and bankruptcy. Maintaining adequate cash prevents this death spiral.
So let me play devil's advocate here.
Please do.
If I'm a newly minted CEO or CFO, right,
Yeah.
and the survival of my entire enterprise, not to mention my own career, rests on avoiding that death spiral, my natural human instinct is just to hoard.
Of course it is.
Right. If meeting the payment schedule keeps the wolves from the door, shouldn't I just build a moat of cash so wide and so deep that a 100-year flood couldn't bankrupt me?
Well, if you do that, you will be fired by your board of directors within a year.
Ouch. Okay, why?
This leads directly to the second core objective, which acts as the gravitational counterbalance, minimizing funds committed as cash balances.
Ah, the opportunity cost.
Exactly. We return to the concept of opportunity cost. Every single dollar that sits idle in a corporate checking account is a dollar that is not being deployed into a high-yield venture.
It is a dollar not funding a revolutionary new research and development project.
It is a dollar not buying out a competitor, and it is a dollar not expanding your manufacturing footprint.
So it's a massive drag on the efficiency of the business.
Exactly. If you build that massive moat of cash, yes, you will never miss a payment.
You'll have pristine credit.
Sure, but your return on invested capital will plummet. You will sacrifice growth. And while you are sitting safely behind your moat, your competitors who are aggressively deploying their capital, running a lean treasury, and investing every excess cent into market expansion.
They will eventually out-innovate, outgrow, and completely crush you.
Exactly. On the flip side, if you run your cash balances too close to the bone to maximize investment, the slightest hiccup in your accounts receivable will send you into insolvency.
So the singular goal of cash management is finding the optimal cash balance.
Yes, that razor-thin mathematical equilibrium that perfectly balances the risk of a liquidity crisis against the massive opportunity cost of uninvested capital.
So it's not about having the most money, it's about having the exact right amount of money at the exact right millisecond.
Beautifully said.
Thanks. But to pinpoint that optimal balance, we need to look at the operational variables that dictate how fast a business burns through its capital.
Right, because every business burns cash differently.
And the most critical metric here, the absolute heartbeat of a firm's liquidity, is the cash cycle, or, as it's often called in the textbooks, the cash conversion cycle.
If we connect this to the bigger picture, the cash cycle is the most important operational timeline you will ever manage as an executive.
It really is.
It measures the exact length of time that capital is locked up and unavailable to the firm. It is the temporal distance between the moment a firm parts with cash to purchase raw materials and the moment it finally collects cash from the sale of the finished goods.
I always visualize this as a relay race, but the baton being passed is a massive stack of the company's money.
I love that analogy.
Yeah, so the race begins the exact second you hand that baton over to a supplier. Say, you pay cash for raw steel and silicon.
Your capital is now locked.
Right. The first leg of the race is manufacturing, turning that steel and silicon into a high-end server rack and letting it sit in a warehouse. That's your day's inventory outstanding.
The longer it sits, the longer you don't have your cash.
Exactly. Then the second leg begins when a client finally buys that server rack. But the race isn't over because enterprise clients don't take cash at the register.
No, they buy on credit.
So the third leg of the race is the waiting game. The client has the server, but you don't have the money. That's your day's sales outstanding.
And the longer that runner takes to get around the track, collect the invoice, and hand the baton back to you at the finish line, the longer your company is forced to survive without its capital.
And while that baton is out on the track, you still have to pay your workforce, your rent, and your taxes.
Which means that a longer cash cycle requires a significantly larger permanent cash balance just to keep the firm breathing while it waits for its own money to return.
This is why masterful corporate leaders are obsessed with shrinking the cash cycle.
They have to be. If you can negotiate longer payment terms with your own suppliers, meaning holding on to your cash longer and simultaneously speed up your manufacturing process and aggressively collect your receivables, you drastically compress that cycle.
And shrinking the cash cycle is the most powerful way to organically free up millions in working capital without ever having to take on expensive external debt or dilute shareholder equity.
It's basically generating cash from thin air just by being efficient.
So the cash cycle dictates the rhythm, but we also have to account for the synchronization of the cash flows themselves.
Right. The exact timing and quantum of the capital moving in and out.
And crucially, we have to calculate the pure cost of cash balance.
This is the constant agonizing math a treasurer does daily, weighing the specific cost of holding excess cash against the specific penalty of falling short.
Like if you run out of cash, what is the cost of securing an emergency overnight line of credit?
What are the penalty interest rates?
Yeah.
You always have to optimize for whichever cost is lower.
And we cannot ignore the subjective qualitative variables either.
No, definitely not. The macroeconomic environment plays a massive role.
Right.
If you are operating during a period of extreme geopolitical instability or facing volatile commodity prices, the mathematical models have to be adjusted to account for that trade uncertainty.
And honestly, the sheer competence and technological sophistication of your internal treasury department will dictate how tightly you can manage these margins.
Very true.
Yeah.
Management staffing matters.
Here's where it gets really interesting. Up until now, we have been talking about cash management conceptually, right?
Sure.
We're talking about cycles and motives and relay races. But when you are the CFO standing in front of an aggressive board of directors or defending your balance sheet to a hostile activist investor, you cannot just speak in metaphors about relay races.
They will laugh you out of the room.
Right. You need rigorous, defensible, hard mathematics. You need to prove exactly why your treasury desk is holding $50 million instead of $40 million.
And this is where we dive into the actual quantitative models used to calculate corporate cash needs. This is what you will be tested on.
We are going to explore 3 foundational frameworks today.
Right.
The Baumol model, the Miller-Orr model, and Orgler's model. Let's start with the classic, the Baumol model.
Okay, so the Baumol model, introduced by William Baumol, is a brilliant adaptation of the economic order quantity, or EOQ model, that is typically used in inventory management.
Oh, right, EOQ.
Yeah.
Yeah.
The underlying premise of Baumol is that a highly rational firm does not leave its precautionary or speculative cash sitting in a checking account earning zero.
Because that would be wasteful.
Exactly. It parks that surplus capital in highly liquid, interest-bearing, short-term marketable securities, like treasury bills or commercial paper.
Right. The money is put to work, earning a modest but safe yield. But inevitably, the firm needs cash to pay its daily bills.
So the treasury desk has to sell some of those securities and move the capital back into the operating account.
And that movement is not free.
No, it is not. Every time the firm liquidates securities, it incurs a transaction cost, brokerage fees, administrative friction, and the sheer labor of the treasury desk executing the trade.
And Baumol makes some very specific assumptions here, right?
Yes. The Baum model is designed for an environment of absolute certainty. It assumes that the firm's cash outflows are perfectly steady and predictable over time.
Like clockwork.
Yes. It also assumes that the transaction cost to liquidate securities is a fixed flat rate regardless of the amount sold, and that the opportunity cost, the interest rate earned on the securities, is constant.
So, under Baumol, the CFO faces a mathematical dilemma. If they liquidate a massive chunk of securities at once, they get a huge pile of cash.
Right.
This means they won't have to make another transaction for a long time, which minimizes those fixed brokerage fees. But by holding that huge pile of cash in the operating account, they are giving up the interest that money could have been earning.
Their holding cost, the opportunity cost, skyrockets.
Right. Conversely, if the CFO wants to maximize interest earned, they'll keep almost everything in securities and only liquidate a tiny amount of cash each day.
Which minimizes the holding cost, sure.
Yeah.
But now they're paying that fixed brokerage fee every single day, and the transaction costs will bleed the firm dry.
So you need an equilibrium.
Exactly. The Baumol model provides an elegant equation to find the exact perfect equilibrium. It calculates the precise cash conversion size that minimizes the total combined sum of both the transaction costs and the holding costs.
Let's actually walk through a concrete example from the source material for the students so they can visualize the math.
Let's do it.
Imagine a fictitious corporation. They need exactly 200,000 rupees a year in cash to operate. That's their total fund requirement. Or B,
Okay.
they can earn 5% interest on their securities, which is the opportunity cost I. And they pay 50 rupees per transaction as a fixed brokerage fee, which is X.
Right. So we have our inputs.
When you plug those numbers into the Baumol formula, which balances those variables, it spits out an optimal cash balance of exactly 10,000 rupees.
And what's beautiful about this optimum point calculated by Baumol is that the total cost of executing the transactions will perfectly equal the total opportunity cost of holding the cash.
Right, because if you hold an optimal balance of 10,000 rupees, your holding cost comes out to 500 rupees.
Yeah.
And your transaction cost for the year also perfectly hits 500 rupees. Total cost, 1,000 rupees.
It is a state of absolute mathematical harmony.
It is brilliant in its simplicity, but as anyone who has ever run a business knows, it has a glaring, fatal flaw.
It does.
It assumes a sterile laboratory environment. It assumes cash leaves the firm at a perfectly steady, entirely predictable drip, like an IV bag.
And real business is not an IV bag.
No, real business is chaotic. A massive client pays an invoice 2 weeks early. A supplier suddenly demands a renegotiation. You get hit with a surprise tax assessment.
Cash flows don't drip. They surge and they plummet entirely randomly.
Which brings us to the evolution of treasury mathematics. The Miller-Orr model.
If Baumol is the predictable laboratory, Miller-Orr is the chaotic real world.
I love Miller-Orr.
It's much more practical. The Miller-Orr model completely discards the fantasy of steady outflows. It operates on the assumption that a firm's net cash flows are inherently stochastic.
Meaning they fluctuate unpredictably from day to day.
Exactly. It assumes these daily changes are normally distributed, meaning they have a mean of 0, but they have a measurable standard deviation or variance.
To visualize Miller-Orr, I want you, the listener, to picture a corporate treasury desk playing a game of bumper bowling.
Oh, this is a great analogy.
Right. In regular bowling, if your ball drifts too far left or right, it falls into the gutter. In this analogy, the bowling ball is the daily cash balance of the firm, bouncing wildly left and right due to the random chaos of daily operations.
And the gutters represent the catastrophic extremes. On one side, complete insolvency. On the other, massive, unforgivable opportunity cost from hoarding cash.
Exactly. And to keep the firm out of the gutters, the Miller-Orr model mathematically constructs bumpers. It establishes 3 specific markers.
A lower control limit, an upper control limit, and a return point somewhere in the middle.
So the lower control limit is the minimum safety stock of cash the firm absolutely requires to avoid triggering a liquidity crisis.
This is usually determined subjectively by management based on their risk tolerance and their access to emergency credit.
So that's a left bumper. The right bumper is the upper control limit, and the center of the lane is the return point. And the operational rule of the Miller-Orr model is basically a masterclass in discipline in action.
Yes. As long as the cash balance, the bowling ball, is bouncing around between the 2 limits, the Treasury desk is instructed to do absolutely nothing.
No transactions, no fees.
Nothing. But the moment the cash balance surges upward, perhaps a massive receivables check clears and touches that upper control limit, an automated Treasury protocol is triggered.
Because the firm officially has too much idle cash.
Exactly. The treasurer immediately executes a transaction, taking that massive surplus and purchasing short-term securities, dropping the cash balance straight back down to the return point in the center of the lane.
And if the opposite happens, if the firm gets hit with a string of unexpected expenses, the cash balance plummets until it hits the lower control limit.
The moment it touches that left bumper, the treasurer immediately liquidates just enough marketable securities to inject cash into the operating account, bringing the balance straight back up to the center return point.
Let's anchor this with the Jane private limited example from the text.
Great.
So management sets a minimum balance, the lower limit of 500,000 rupees. The historical variance of their cash flows is 1.2 million. The transaction cost is 10,000 rupees, and the yield on securities is 3%.
Okay.
When you feed that variance and those costs into the Miller-Orr formula, it calculates the spread, which gives you your return point. In this case, the return point is 547,356 rupees.
In the upper limit.
The upper limit mathematically computes to 642,068 rupees.
So the bumpers are set.
Exactly. The firm just lets the cash bounce between 500K and 642K, only intervening when it hits the walls.
The brilliance of Miller-Orr really lies in how it calculates the exact distance between these limits, what the model calls the spread, which you just mentioned.
Right.
The spread is determined by a complex formula that factors in the fixed transaction costs, the daily interest rate, and most importantly, the historical variance of the firm's cash flows.
Because if a firm's cash flows are highly volatile and chaotic, the model mathematically widens the spread. It moves the bumpers further apart.
Why? Because if the bumpers are too close together in a chaotic environment, the cash balance will constantly hit them, forcing the treasurer to buy and sell securities every single hour, generating massive transaction fees.
Which defeats the purpose.
Exactly. By widening the spread, the model tolerates more cash fluctuation to save on brokerage costs.
It's an incredibly dynamic, self-correcting system. But even Miller-Orr treats cash management as a slightly isolated function, doesn't it?
It does. It looks at the cash balance in the securities portfolio, but it doesn't deeply integrate with the factory floor or the supply chain.
And that is where we reach the pinnacle of quantitative treasury frameworks. Orgler's model.
Oh, Orgler's model.
Yeah.
This is what we call an integrated comprehensive approach. It does not treat the treasury desk as an isolated silo.
None at all.
It utilizes multiple linear programming to integrate cash management directly with the firm's production schedules, its inventory purchasing, and its vast array of financing options.
It basically tries to map the entire complex reality of a multinational corporation into one unified algebraic equation.
For an MBA student, the term multiple linear programming might sound intimidating, but conceptually, it is about optimizing a specific objective function while strictly adhering to a complex set of operational constraints.
Right. Orgler's model typically uses a one-year planning horizon broken down into 12 monthly periods. And it incorporates an astonishing number of decision variables.
It looks at everything: the exact payment schedule for every supplier, the firm's options for drawing down short-term credit lines versus issuing commercial paper, the yield curve on various marketable securities, and the daily cash balance itself.
And the objective function, the ultimate goal the algorithm is trying to solve for, is to minimize the horizon value of the net revenues from the cash budget over the entire year.
To put that in human terms, the model rigorously calculates the exact ripple effect of every single operational decision.
Give me an example.
Okay, so if the factory manager decides to run a third shift of production, that requires more raw materials, which draws down cash, which might force the firm to tap a short-term line of credit, which incurs an interest expense, which ultimately impacts the final net revenue.
So it's all connected.
Exactly. The model mathematically recognizes that every operation, whether it is delaying a payment to a vendor by 3 days or accelerating shipment of finished goods, directly creates or destroys profit based on its impact on the firm's liquidity.
It is the holy grail of financial engineering, really. Integrating operational reality with pure treasury strategy.
It is breathtakingly sophisticated.
It is. But we also have to acknowledge the reality of the corporate trenches here. While a Fortune 50 company might be running custom linear programming models on a mainframe, the vast majority of financial managers rely on a much more pragmatic, slightly less abstract tool.
The cash budget.
The cash budget. Sometimes you don't need to calculate the standard deviation of your daily variance. You just need to accurately map out reality.
Absolutely. The mathematical models provide theoretical optimization, but the cash budget is the operational battle plan.
Right.
A cash budget is a rigorous, detailed forecast of every single dollar expected to enter and leave the firm's accounts over a specific time period.
So the CFO takes the sales forecasts from the revenue team, the production schedules from operations, and the capital expenditure plans from the executive board, and just maps them onto a calendar.
And if the budget reveals that in October, massive inventory purchases will outstrip collections, projecting a dangerous cash deficit, the CFO doesn't panic in October.
No, they act in July.
Exactly. They secure a short-term loan facility months in advance at highly favorable rates.
And if the budget projects a massive surplus in December, they begin researching high-yield, short-term investment vehicles to deploy that capital the exact second it arrives.
So the models give you the target, but the budget gives you the roadmap.
Okay, so that brings us to the execution phase. Because now that the CFO knows exactly what the optimal cash balance needs to be, what actual physical levers can the management team pull to hit those targets?
How do they organically manipulate their cash position?
Exactly. This introduces 4 primary cash management strategies aimed at stretching a firm's liquidity without breaking its operations. Let's get into the strategies.
The first strategic lever is stretching accounts payable.
Okay.
The concept is incredibly simple. Delay parting with your cash for as long as humanly and legally possible.
Right. If a supplier gives you 30 days to pay an invoice, you do not pay it on day 12.
I paid on day 30, right at the buzzer. By holding onto that cash for an extra 18 days, you keep your capital invested, earning interest for you rather than for your supplier.
I mean, it sounds like a no-brainer, but it is fraught with peril. There is a massive caveat here that students need to grasp. You have to stretch payables without destroying your credit rating and without alienating the critical suppliers who keep your business running.
Yes, relationship management is key.
And crucially, you have to weigh the delay against the opportunity cost of cash discounts. This is a massive trap for young financial analysts.
Oh, absolutely.
If a vendor's terms are 210, net 30, meaning you have 30 days to pay, but they will give you a 2% discount if you pay within 10 days. Blindly stretching the payment to day 30 is often just financial malpractice.
This raises an important question of financial literacy, actually. A 2% discount might sound trivial to an untrained ear.
Right, it's just 2%.
But you are essentially earning a 2% return for advancing the payment by just 20 days. If you annualize that rate, compounding that 2% over 18 20-day periods in a year, the effective annual interest rate you are earning by taking that discount is staggering.
It often exceeds 36%.
Yes, and there is virtually no short-term marketable security on earth that yields a guaranteed 36%. So a sophisticated treasurer will aggressively pull cash from their credit lines to capture those discounts rather than stretching the payable.
That's such a great point. Okay, strategy 2 shifts our focus from the finance desk to the factory floor. Efficient inventory and production management.
Remember our relay race analogy.
Yes. Cash gets physically trapped inside raw materials and finished goods. If you walk into a company's massive warehouse and see thousands of pallets of unsold product just gathering dust, you are looking at millions of dollars of paralyzed cash.
To optimize liquidity, a firm must aggressively increase its inventory turnover. This means moving toward just-in-time, or JIT manufacturing principles.
It requires tightening the production cycle so that raw materials are converted into finished goods faster.
And flawlessly coordinating sales forecasting with production planning so that goods are shipped the moment they roll off the line. Every single day a product sits on a shelf, it is consuming the firm's working capital.
And once that product finally leaves the warehouse, we hit strategy 3. Speeding the collection of accounts receivable.
This is the exact inverse of stretching payables.
Right. Just as you want to pay your suppliers as late as possible, you want your customers to pay you as fast as humanly possible.
A firm can achieve this by structurally adjusting its credit terms, demanding payment in 15 days instead of 30, or requiring a 50% deposit up front before manufacturing even begins.
It also involves tightening credit standards. The sales team might want to sell to anyone to boost their commission, but the Treasury desk must step in and refuse to extend credit to clients with a history of delinquent payments.
But this introduces a very dangerous tension, which brings us to the fourth strategy, the combined strategy.
Because you cannot implement these first 3 strategies in isolation or push any of them to their absolute extreme.
No, because if you do, the math might look perfect, but the business will collapse.
That is a critical insight for any future executive. Let's look at the systemic consequences of being too aggressive. If you ruthlessly stretch your accounts payable to 90 days, demanding punitive terms from your suppliers to hoard your own cash, those suppliers will rebel.
They absolutely will. They will prioritize shipments to your competitors. They will secretly bake the cost of your delayed payments into the prices they charge you, which erodes your gross margins.
And on the other side, if you apply draconian credit terms to your own customers, harassing them with aggressive collection agencies on day 16, they will simply take their business to a competitor offering more lenient terms.
So you lose your supply and your demand.
Exactly. I always liken this combined strategy to the human respiratory system.
Okay, tell me more.
Stretching your payables, holding onto your cash, is like holding your breath in. It keeps the oxygen inside your body. Speeding up your receivables, forcing cash to come in faster, is like exhaling forcefully.
Right.
If you just hold your breath until you turn blue, or if you hyperventilate by exhaling too aggressively, the organism passes out.
You have to integrate these strategies into a smooth, sustainable rhythm. You have to optimize liquidity, working capital, and operational risk simultaneously.
Corporate finance at this level is an exercise in diplomacy, supply chain resilience, and relationship management, just as much as it is an exercise in applied mathematics.
That's so true. The numbers on the spreadsheet represent real human behavior and deeply interconnected global supply chains. Navigating that friction is what separates a junior spreadsheet analyst from a master chief financial officer.
So we have the strategic frameworks, we have the models, and we have the broad levers. Now we move from the boardroom to the trenches.
The boots on the ground.
Yes, we are talking about cash management techniques. Because strategies are the macro-level plans, but techniques are the specific physical, structural tools that Treasury departments build to execute those plans on a daily basis.
The foundational technique is basically just basic operational hygiene. Collect quickly and monitor costs and inventory.
It sounds elementary.
It does, but the sheer volume of capital lost to administrative lethargy is staggering. Firms must decentralize and accelerate their billing processes. Do not wait until the end of the month to batch process invoices.
Invoicing must be triggered the exact second a shipping manifest is signed.
Furthermore, the probability of collecting a debt decays exponentially over time.
Right. The longer a receivables team waits to contact a delinquent account, the closer that receivable gets to becoming a permanent bad debt.
Simultaneously, procurement teams must constantly monitor supplier relationships, continually shopping the market not just for lower prices, but for extended payment terms that structurally improve the firm's cash position.
But the real magic happens when we get into the structural banking architecture. Let's look at a technique called concentration banking.
This is a powerful one.
It is. This is designed specifically for large, geographically dispersed firms. Imagine a massive national retail chain with 1,000 stores spread across the country.
Okay. Historically, if every single one of those 1,000 stores mailed their daily cash receipts and checks to a central corporate headquarters, the capital would spend days trapped in postal transit.
Just sitting in a mail truck.
Yes, followed by days of internal processing before finally being deposited. Concentration banking completely rewires this architecture.
How?
Under this system, the firm establishes a sprawling network of localized banking relationships. Each individual retail store deposits its daily take directly into a local branch of a regional bank.
And then, through automated standing orders, those hundreds of regional banks electronically funnel the accumulated funds into a single, massive concentration account at the firm's primary principal commercial bank.
Exactly. It decentralizes the collection, but instantly centralizes the capital.
The corporate treasury desk in New York doesn't have to wait for a check from a store in rural Texas to travel through the mail.
No, the funds are swept electronically into the central pool, giving the CFO immediate consolidated visibility and total control over the firm's aggregate liquidity.
Allowing them to instantly deploy that massive pool of capital into overnight investment vehicles.
And a highly related technique for accelerating collections from major business-to-business clients is the lockbox system.
Ugh, lockboxes. If concentration banking is about routing retail cash, the lockbox is about circumventing the corporate mailroom entirely.
For a B2B firm receiving massive payments via check, internal processing is a massive bottleneck. A check arrives at corporate headquarters, sits in the mailroom, gets sorted, travels to the accounting department,
Waits on a clerk's desk to be matched with an invoice.
gets entered into the ledger, and is finally physically transported to the bank. This can trap millions of dollars in a multi-day administrative purgatory.
The lockbox system is a brilliant hack to avoid all that. The corporation rents strategic post office boxes, lockboxes, in the specific geographic hubs where their largest customers are located.
Right. They instruct the customers to mail their payments directly to those regional P.O. boxes, but the corporation never actually visits the box.
Never. The corporation signs an agreement granting their local commercial bank exclusive direct access to the lockbox.
The bank's personnel physically empty the lockbox multiple times a day. The bank intercepts the checks, immediately endorses them, injects them directly into the banking clearing system, and credits the firm's account.
They then securely transmit the scanned remittance data back to the corporation's accounting department for ledger reconciliation.
By entirely bypassing the postal transit across the country and completely eliminating the corporation's own internal processing delays, the lockbox system accelerates the collection cycle by several days.
And when you're dealing with hundreds of millions of dollars, accelerating collection by 3 days generates a massive windfall of captured interest.
Absolutely massive.
Speaking of the actual mechanics of checks clearing and traveling through the system, we are arriving at what I consider the most conceptually fascinating, slightly controversial, and historically significant part of corporate cash management.
Float.
Float.
Float is a critical concept to deeply understand because it highlights the fundamental difference between accounting reality and banking reality.
Put simply, float is the temporal discrepancy, the gap between the cash balance officially recorded in the corporation's internal accounting ledger and the actual usable funds currently sitting in its commercial bank account.
Because of the friction in the financial system, the time it takes for a check to physically travel through the mail and the time it takes for the banking syndicate to actually clear and settle the funds, these two numbers are almost never identical.
Let's break this down meticulously into its two components for the students. First, we have disbursement float.
Okay.
This is float that works in the company's favor. It occurs when a corporation writes a check to pay a bill, but the recipient hasn't cashed it yet or the banking system hasn't cleared it.
Let's look at a concrete corporate scenario to make this clear. Apex Innovations has exactly $10 million in its checking account, and its internal accounting ledger accurately reflects that $10 million balance.
Got it.
On Tuesday, the CFO writes a massive $2 million check to a primary steel supplier. The moment that check is signed and put in the mail, the accounting department deducts the $2 million.
So Apex's internal ledger now reads $8 million.
But the supplier has to physically receive the check, process it, deposit at their own bank, and then their bank must formally demand the funds from Apex's bank through the clearinghouse.
Let's say that entire cumbersome process takes 4 days.
Right.
From Tuesday until Saturday, Apex's internal ledger says they only have $8 million. But if you look at their actual commercial bank account, the full $10 million is still sitting there, untouched.
That invisible $2 million phantom balance that exists for those 4 days is the disbursement float.
And the precise opposite of that mechanism is collection float.
This is the float that actively works against the corporation. It happens when you receive a massive payment and deposit it, but your bank places a hold on the funds while they wait to physically collect the capital from the customer's bank.
So Apex Innovations receives a $3 million check from a client. The accounting department is thrilled. They immediately log the payment, increasing the internal ledger balance.
The ledger looks incredibly healthy.
But the bank says, we have the piece of paper, but they don't have the money yet. We need 3 days to clear this.
For those 3 days, the internal ledger is artificially high, but the actual spendable bank balance is severely lacking. That agonizing waiting period is the collection float.
So a sophisticated corporate treasurer is constantly calculating the firm's net float.
Yes. The net float is the aggregate difference between the actual available bank balance and the internal ledger balance at any given second.
If a firm's disbursement float, the checks they have written that haven't cleared, is significantly larger than their collection float, they are operating with a positive net float.
Their bank account literally contains millions of dollars more than their accounting books claim they have.
And this is where the history of corporate finance gets wild.
Oh, it really does.
In the 1980s and 90s, massive blue-chip corporations didn't just passively observe their float, they actively weaponized it. They aggressively played the float.
Treasurers would deliberately write massive, multi-million-dollar checks to pay obligations, knowing with absolute certainty that they did not have sufficient capital in the bank to cover those checks at the moment they signed them.
They relied entirely on their mathematical models, predicting that the check would take exactly 5 days to traverse the clearing system, and they planned to inject fresh revenue into the account on day 4, covering the check just hours before it cleared.
It was a very common practice.
But honestly, wait, pushing back on this for a second, playing the float sounds incredibly dangerous. It sounds almost indistinguishable from check kiting, which is a federal crime.
It borders on it.
Writing checks with money you don't have. Is this a strategy an MBA student should be studying to deploy today, or is this just historical financial cowboy behavior?
This raises a vital question about risk, legality, and systemic evolution. You are absolutely right to push back. Playing the float was an incredibly high-wire act.
I mean, if a treasurer miscalculated the clearing time by a single day, the check would bounce.
The firm's pristine credit rating would be incinerated, and it could trigger technical default covenants on massive corporate debt.
It's crazy.
However, historically it was legal, and it was a massive corporate game. To maximize disbursement float, Fortune 500 companies would intentionally establish disbursement accounts at obscure, highly remote regional banks, perhaps a tiny branch in rural North Dakota.
Wait, really?
Yes. They would write checks to their East Coast suppliers drawn on that North Dakota bank purely to add 3 extra days of transit and clearing friction to the process, earning 3 extra days of interest on tens of millions of dollars.
That is wild. It was geographical arbitrage of the banking system's inefficiency.
Exactly. But here is the massive paradigm shift that every modern student of finance must understand. You cannot build a career on playing the float today because the friction that created the float has been structurally annihilated.
And that brings us to the ultimate modern technique, electronic data interchange, specifically financial EDI or FIDEO.
Modern technology systematically hunted down and destroyed the float. ADI is the direct, secure, machine-to-machine electronic transfer of information and capital between transacting parties and their financial institutions.
We are talking about automated clearinghouse or ACH, networks, wire transfers, and national real-time gross settlement systems like RTGS and NEFT.
Under a fully integrated VADI system, there is no paper invoice mailed across the country. The supplier's Enterprise Resource Planning, or ERP, software securely transmits an encrypted electronic bill directly to the buyer's ERP software.
And then the buyer's treasury desk reviews the digital invoice and clicks a button to authorize payment.
Instantly, an encrypted instruction is sent to the buyer's bank and the funds are transferred electronically, settling in the supplier's bank account in a matter of hours, or in many modern systems, literally milliseconds.
Exactly. ADI eliminates the mail transit time. It eliminates the manual sorting in the corporate mailroom. It eliminates the manual data entry by accounting clerks, and it eliminates the days-long clearinghouse hold by the banking syndicate.
The net systemic effect of this technological revolution is that the temporal gap between initiating a payment and settling a payment has collapsed from a week down to near zero.
And when clearing time drops to zero, float simply ceases to exist.
You cannot play the float because the temporal friction you were exploiting has been permanently erased from the financial system.
Which perfectly sets the stage for our final major exploration, the global context.
We have to look at how these practices operate not just in a textbook, but across the sprawling, infinitely complex reality of multinational corporations, or MNCs.
Because the evolution of cash management over the last 50 years was driven by two massive macroeconomic forces. The second force was the technological revolution of FEDIs that we just discussed.
But the first force was the historic, terrifying macroeconomic shock of the 1970s and 80s.
Yes. During that era, global inflation skyrocketed, and central banks responded by hiking interest rates to unprecedented levels.
The prime rate touched 20%. Suddenly, the opportunity cost of holding idle cash wasn't just a minor inefficiency. It was a lethal, existential threat to corporate profitability.
Leaving $50 million sitting idle when short-term yields were at 15% was grounds for immediate termination.
That macroeconomic shock is what forced the corporate treasury function to evolve from a sleepy administrative bookkeeping role into a ruthless, highly quantitative strategic powerhouse.
It is why models like Miller-Orr and complex linear programming became mandatory for survival.
And when you take that quantitative rigor and apply it globally, the complexity scales exponentially. Managing cash for a massive multinational, let's use the example of a conglomerate like Unilever, is an almost incomprehensibly daunting logistical nightmare compared to running a purely domestic operation.
I mean, Unilever manufactures physical goods, processes raw materials, and sells consumer products in over 190 countries simultaneously.
To simply operate within the legal and financial frameworks of those 190 jurisdictions, a multinational must maintain a staggering web of global bank accounts. Because cross-border capital movement is highly restricted and heavily taxed. They need banking transactions to clear locally to avoid massive foreign exchange friction, exorbitant wire fees, and withholding taxes.
So if they sell soap in Germany, the euros must be deposited into a German commercial account?
If they pay factory workers in Indonesia, the rupiah must be dispersed from an Indonesian account.
I picture the treasurer of a multinational staring at a wall of monitors, playing a high-stakes global game of whack-a-mole across 20 different time zones.
That's a very accurate picture.
On any given Tuesday, the exact scenario we discussed earlier plays out on a macro scale. Unilever's North American divisions might have just completed a massive holiday sales push. Their U.S. bank accounts are overflowing with a massive surplus of tens of millions of dollars in idle cash.
But simultaneously, their manufacturing division in Latin America is facing a massive cash deficit because they are aggressively purchasing raw commodities for the next quarter's production.
The mole of a cash deficit pops up in Brazil, while the hammer of surplus cash is sitting uselessly in New York.
And this is where the sophistication of the Treasury desk is deeply tested. If they do not have a globally centralized, deeply integrated cash management system, they suffer a catastrophic double penalty.
What happens?
Well, the Brazilian subsidiary, facing a liquidity crisis, will be forced to go to a local Brazilian bank and secure an emergency short-term loan at punitive emerging market interest rates just to keep the factory running.
Meanwhile, millions of dollars of the corporation's own capital is sitting completely idle in New York, earning a negligible yield.
They're essentially paying exorbitant interest to borrow their own money.
So the ultimate challenge for the modern MNC Treasury is building a frictionless, globally coordinated nervous system.
They require technological infrastructure that provides absolute, real-time visibility into every single account worldwide.
More importantly, they employ advanced techniques like cash pooling.
Right. They set up sophisticated internal banking structures where the parent company acts as a central bank for its own subsidiaries.
Through automated sweeps, the surplus cash from the U.S. account is instantly pooled into a master account, converted via tightly hedged foreign exchange contracts, and electronically injected into the Brazilian account as an internal intercompany loan.
Completely bypassing the external banking syndicate.
It is financial logistics executed on a planetary scale. The Treasury desk isn't just managing money, they are managing currency risk, sovereign regulatory frameworks, global tax liabilities, and geopolitical friction.
Instantly routing the financial lifeblood of the company across the globe to optimize yield and ensure survival.
It is incredible. We have covered a massive amount of ground today, navigating the absolute core of corporate finance. For the MBA student listening, preparing to step into the arena, let's crystallize the journey we just took.
We stripped away the illusion that cash is just money in a bank.
We define the complex competing motives, transactional flow, precautionary armor, speculative firepower, and banking compensation.
We explored the terrifying tightrope walk of the CFO, desperately holding enough liquidity to stave off bankruptcy, while ruthlessly minimizing idle balances to avoid the silent, compounding death of opportunity cost.
We dissected the operational heartbeat of the firm, the cash conversion cycle, recognizing that time literally is money.
We moved through the mathematical evolution of the Treasury, from Baumol's elegant but rigid EOQ formula to the dynamic, variance-driven bumpers of Miller-Orr, arriving at the total systemic integration of Orgler's linear programming.
We translated those formulas into physical operational strategies, strategically delaying payables, hyper-accelerating inventory velocity, and tightening receivables, and the delicate diplomatic balance required to execute them without shattering the supply chain.
We looked at the mechanical architecture of lockboxes and concentration networks.
We explored the historical Wild West of playing the float and how the relentless march of electronic data interchange eliminated that temporal friction forever.
And finally, we scaled the entire framework globally, looking at the massive complexities of routing liquidity across sovereign borders and volatile currencies.
So what does this all mean? It means cash management is not an administrative chore relegated to the back office. It is the strategic, pulsating heartbeat of the enterprise.
It dictates, with absolute finality, whether a company has the resilience to survive a crisis, the agility to seize a fleeting market opportunity, and the efficiency to outpace its competitors.
But before we conclude, we want to leave you with a final thought. A provocation that pushes beyond the boundaries of your current textbooks and forces you to look at the horizon of financial engineering.
Consider this fundamental reality. The classic mathematical models we explored today, particularly Baumol and Miller-Orr, derive their entire mathematical structure from the existence of friction.
Right. They exist to calculate the optimal balance between the opportunity cost of holding cash against the strict transaction cost and transfer time of moving assets.
But the architecture of global finance is currently undergoing a seismic mutation. We are rapidly moving into an era of instantaneous, blockchain-based settlements, central bank digital currencies, and algorithmic, smart contract-driven treasury execution.
If the transaction cost of liquidating an asset drops to functionally zero and the global transfer time becomes genuinely instantaneous, the foundational assumptions of Miller-Orr begin to collapse.
If a corporate treasurer can algorithmically liquefy a fraction of a treasury bill at zero cost exactly 1 millisecond before a supplier's invoice comes due, why would the firm ever hold a standing cash balance at all?
Will the very concept of corporate cash even exist in a recognizable form 10 years from now? Or will liquidity become a purely algorithmic state of continuous, friction-free conversion?
That is the caliber of question a future corporate leader must be prepared to answer. The foundational mechanics of corporate finance are evolving, and you are the ones who will have to build the new models.
Good luck on your MBA journey. Good luck on your exams. And keep diving deep into the hidden machinery of the business world. You've got this.